All right. Good morning, everybody. The big number this week is going to be Wednesday. As we usually do with the morning briefing, we want to start out with what happened in the overnight hours. Monday is even more important when it comes to what happened, because the market, when we open up at 9:30 on Monday, is going to price in everything that happened over the weekend. So not just one overnight, but 3 overnights, right? Overnight Friday, overnight Saturday, overnight Sunday. So that price discovery has to price in those 3 days of news and information. There is this market logic that says everything you need to know has already been priced into the candles. Now, whether that is something that you subscribe to or not, the market still needs to absorb a lot of that data and a lot of that information. Getting a little bit of a heads up on what that information might be kind of gets you prepared for Monday. This European market wrap on Finance Juice is something that I look forward to reading every morning. It's short and sweet. I don't have to, like read a damn book. I want a couple of sentences. Line me up on what happened in the overnight hours, what's going on around the world. The idea would be that if there was a particular sector industry index from the Asian market or from the European market that is going to carry over into today's session, then I'd want to know about it. I'd want to kind of get my eye on that. Right now, it still looks like a lot of short covering and chasing, performance chasing by a lot of those fund managers. I don't think that it's going to slow down before September, really. Unless there's something that comes along news-wise that knocks us out of place, we're going to continue to anticipate a rally in names perhaps other than the monsters of tech, but definitely in the tech sector. It's what we've seen a lot of last week. The internals, the market breadth, the flows have just been phenomenally strong. So we're likely to continue to rally into September and then sell off into the later part of the year and retest the lows. So here we're looking at a daily chart of the ES. And we're looking at how far away from the daily moving average we are from a 10-day moving average. You can see that we're only about 1.5% away from the moving average. We are above it, obviously. We look at something like that to kind of get a gauge for how far the market has run has the moving average caught up to it. When we get back to the center, it's like getting back to the middle of a basketball court. If the game is played from both sides and there's a goal on each end, then the center of the court is the starting point. We're not back to the center of the court, but we have had a nice decline since the 1st of August, where we've been fading down from them elevated levels. This shows that the market has the capacity to make some significant moves without becoming, quote, overbought or oversold, which I really don't like using that kind of language, but it states things, pretty clearly. We are really close to that cyan line. That is an anchored VWAP from the first of the year. When we are above that anchored VWAP, a market is considered healthy, strong. It's also a benchmark. It's also the yearly average price of this market. It's another way to look at it. We got the white line running across the screen from left to right, from high to low. We are in a turning pattern here, where we've set these lows. We're starting to come back the other direction. It takes a significant amount of time for that white line to turn around and begin going the other way. When we were trending downward, it was a really great indicator for identifying the swing highs and the swing lows. Depending on how we resolve this, if we yet again get a new swing or a new higher low, then we'll have a full set. And a full set is 2 higher highs and 2 higher lows. At which point we would have put in a base, we'd put in a bottom, and we've started working our way back up on the other side. For the week, we want to look at the weekly expected move. Kind of ask the question, is this week expected to be as violent and volatile as last week? Is the market pricing in a bigger expected move than last week? And yes, but just barely, almost negligible, right? Not even enough to even acknowledge that it's bigger. We are IX10 at this point. Although, if we're using 8-3 candle, that's a really wide, very large candle. Having an IX10 pattern inside of a large candle, not really exciting, right? Doesn't really imply that much compression. If we narrow things down to 8-4, and you tolerate wicks, then we're in the IX10 in a very compressed market. So we're going to be looking for a breakout of 8-4 that sticks, because we broke out on 8-5, but it didn't stick. Right? That's why we got that really long wick. A topside breakout of that 8-4 range, which would be 41.72, very likely is going to take us to the roundy of 4,200, and very likely to the cog line 42.11, which would get us above the year-to-date VWAP and close to the top of the weekly expected move. So significant level on the top side if we happen to break out to the upside this morning. I don't think it's going to happen before Wednesday, or that if we break out above it, that we wick out and come back in again. I think that's more likely until Wednesday. Once Wednesday gets here, game on. So why Wednesday? CPI data. It's all about inflation expectations, and the Fed has made it very clear that they want inflation data with no gray area, no shades of gray, no ambiguity, no head scratching, no confusion, no doubt. They want to see that inflation 100% is on the decline. They've made that very clear. Some of this data Wednesday is going to help paint that picture. So it's very likely a market in a wait and see pattern. GEX and DEX levels are also dropping off. For those of you who are math nerds like me, think about a set of data points. Say you have 50 data points. And when you put those data points together, you form your average. Well, if you are constantly dropping off the last bit of data when you get new data, and some of the data that you're dropping off happens to be very large numbers, then your entire data set gets reset at a much lower rate, right? Much lower value. Not because your new numbers necessarily are showing such an increase or a decrease, but because you've lost on the backside of your data points very large numbers. When it comes to DEX and GEX, that's what we're getting. It's what we've been getting in the last week or two. Another 3% is supposed to come off today, maybe tomorrow. So we're going to continue to see those volatility levels in GEX and DEX drop significantly. And for the VC funds, that forces them to buy. They don't get to choose. The model says do, they do. Right? So when the model drops to the volatility level that they deem as a buy criteria, the algo just goes out and starts buying in the basket. It's what it's supposed to do. Now, it's not trillions of dollars, it's only billions. But billions matters when you're talking inflows. All right, so enough nerd talk. Let's take a look at the S&P here. I'm trying to get used to a new keyboard, so if I screw something up, you'll know why. We are underneath the previous week's high. It's a good starting point for the week because I do like trading an inside week breakout. So we have that on deck just because it's over our head. Boom, boom, boom. We had an inside day breakout earlier this morning, couldn't keep it, faded back down. That gives us a Globex high of 41, we'll call it 41.70. We got an ADR right now of 1.75%. If you don't speak percentages, that's around $75, 75 points. So the focus or the attention right now is, are we going to get another day of compression? Another day that reduces this average daily range even more? There's three things the market can do. It can hold the line, staying sideways within this range, break to the upside and advance, break to the downside and decline. Looking at the volume this morning, we had a lot more volume now than we did Friday morning. Less than we did last Thursday. About average with Wednesday. Less than Thursday. Slightly more than Monday. So when we're talking about Wednesday being the catalyst and likely seeing a market wait for the play. So far, the levels aren't showing that. We're kind of in line, right? Nothing really standing out. I'll widen the point of view here for a moment. I know it's a little hard to see, right? With all that junk on the screen. Just kind of ignore the junk for a moment. Focus on those candles. This is the range that we're dealing with. 4,100 to 4,175. If we break 4,100, then we're going to focus on the previous week's low, around 4180 or 4080, excuse me. That would be a 100-point move from 4175, 4180-ish to 4080. We take that box, widen it out significantly. And that becomes the range. That's last week's data. So we're significantly above the pivot point, the daily pivot, the weekly pivot, and we're flirting with the previous week's high. We do have additional auctions today at 11:30. Those very often become game changers, V bottoms, midday reversals. I absolutely love those additional auctions. Keep your eye on the 11:30 time frame. The base case argument, the more likely scenario today is that we remain range bound. The pivot points for that range bound argument is the Globex Open of last night, the Globex Open of the previous day, the Globex low before that jobs number data, which is around 41.46. The daily pivot point, the weekly pivot point, our own Globex low, then a pretty significant drop down to ADR half at 41.13, which is basically the cog line of 49.11, excuse me, 41.11. The RTH Open, 41.07. Yesterday's low, 41.03. So basically what we're looking at here for our range bound argument is that we retrace or stay within this 80-point range, bouncing through these pivot points. The 50% retrace, 41.26. If this is going to be our day, we're going to see a choppy tick. Going to have a sweeping gestures in the C tick. So it's just going to kind of muddy waters. It's going to look a lot like Friday and Thursday. If that range base argument plays out today, today's going to look a lot like Thursday and Friday. So what I would be interested in is the alternate scenario. Perhaps that we break out of the top, right? We start with that argument. So with the top side breakout, we want to focus on first getting through our own Globex high, breaking out on the week, which would be an inside week breakout. 41.86 for an ADR half. and 42.22 for a full ADR. Now, if you're looking at 42.22 thinking, yeah, right, that's a bit of a stretch. It's the ADR. We very easily can move the ADR. It's the average daily range. So not much of a stretch at all. It would be worth marking out perhaps last week's range with the Fibonacci and looking at where the warning center is, which is the 111. That would put us at 41.85, just kind of a little bit of rounding. And the Fibonacci target, which would be 41.95. So the concern is if we do break out of the top side here, watch for 41.83 to be a reversal zone. That we get into that, we don't get through it, and we pull back and dump back into the range. If we do get above 41.84, 41.85, then we're much, much more likely to go to 41.95. The third argument is that we break out of the downside. This is the least likely scenario on the day. Now, I've said that statement a number of times this year, and it ended up being what we got for the day, almost like a curse. I say it's likely that we don't do it, and that's the thing we end up doing. So knock on wood, the expectation is that we don't break out of the bottom of yesterday's range, but we can break out of the bottom. There's nothing says that we can't. It's well within our range. The full ADR is 40.76. The bottom of the range is 41.03. So you're looking at a 25-point range beyond the bottom of yesterday's range that would still be considered a normal move in the market. We're looking at a 10-day, 30-minute volume profile with TPO on the right side. When we're looking at this, we want to think about how wide the volume profile is. From the value area high to the value area low. When we think about width, we have to have something to put it into context. So in the last 10 days, we've got our absolute high and we've got our absolute low. We'll call it 39.11, the cog line, and 41.70. So when we're looking at this profile, we want to kind of gauge how much of this entire range is taking up the 70% of the volume. More than half. The more narrow this gets, the more compressed the measurements that we're looking at, and the bigger the move that we're likely to see should we finally break the profile. Now, the way that we do things when it comes to this profile is when we're at the top of the box, we expect to go to the bottom of the box. When we're at the bottom, we expect to go to the top. If we were outside the box, we would expect to come back into the box. Well, right now, we are just peeking out of the top of the box. Just barely. That line is just bugging me. Ha. Ah. All right. So we just barely peeked outside the box. If we begin to expand beyond the edge of this box, to the upside, there's nothing there, right? There's no volume profile. It's not just the value area high. It's basically the top of the profile. So we don't have anything up there overhead volume wise that we need to be concerned with that we're going to hit anything. So there's nothing there. All right, we're looking at a 5-day, 5-minute. I call it mapping out the 5x5. We have an untouched value area low from yesterday. That's about it because the point of control and the value area high has already been hit. There's nothing to carry forward from the other volume profiles. And while there are some untouched point of controls much lower down, we wouldn't focus on those because we have no expectation that we're going to get that low today. When I started this morning, I talked about a full set coming off of the lows and looking at continued short coverings and performance chasing and seeing the S&P continue to advance into September as long as no major data points freak the market out. So we're going to continue to expect that other names other than the big tech is likely to continue to advance to the upside, that we do not revisit the lows. So we want to focus on a new swing high, swing low. If you use your drawing tool, it's the line with the R on it. It's called a regression line. It won't matter up or down where you start the line, it will start on the candle. So with this in mind, we focus on mid-June, start the drawing and just drag your mouse to the right. You get this linear regression line. Once you snap that line, you'll notice it becomes a lot clearer where the swing highs and the swing lows are. The data points very often match. So if you get like a 2% move on one side, you're very likely going to get a 2-point move on the other side. We want to continue to match with higher lows and higher highs. turn the lines off on this thing for a moment, just for clarity. You look in the upper left corner, without all of the lines, we have a decreasing bearish strength. So when we're doing technical analysis and we're looking at the bearishness of the market year to date from January 3, which was the first day of the market year, to present, we had strong bearish strength, right? Obviously, the market was going down. The sweep and the breadth and the pace of the tape, it was a strong bearish market. Well, that strong bearish market is decreasing. The strength of that bearishness is decreasing. Since the mid-June reversal, we're in a bullish trend. If we're running with technical analysis on what is considered, quote, trend, this qualifies 100%. We're above the 50, we're above the 20 is above the 50, that's a bullish trend. We got bullish momentum. And we've got a surge upwards. So all the bobbing heads on TV, everybody that's talking about how, we should be bearish, the market's going down, everything's crashing and burning. If you turn all that off and you just look at what you have on the chart, you've got the improving internals. We're not very far away from improving bullish strength instead of decreasing bearish strength. It's about to flip to increasing bullish strength. We're not very far away from that metric. So then we'll have across the board, all four of these, positive and bullish. Trade what you have, right? Don't let those bobbing heads on TV freak you out. We're very likely going to continue with these long moves, these upside plays, until at least the early part of September, right? The pace of the balance sheet reduction in September is supposed to increase significantly. So maybe in the earlier part of September, even though it's not going to be the FOMC yet, we could start to see some real changes around the time of that new balance sheet reduction. But until then, run what you got, right? What we got is strength. Bullish surge, bullish momentum, bullish trend, and improving bullish strength. So with that in mind, we're going to continue to watch the monsters of tech, the MOTs, because they make a great intraday indicator. We really don't want to focus our trades there, right? If they're the ones that are underperforming, then we'll focus on something that is performing. Simple metric for me on that is liquidity. I tend to focus on the names that have the liquidity that can support our trading. So weekly options, if a company has weekly options, it's because it earned it through liquidity. It doesn't just decide, well, I want to have weekly options. If it is heavily traded, it earns the right to have weekly options. So a nice starting point on liquidity is, are there weekly options on this company that I want to trade? If you were to look at Thinkorswim and run a scan for the number of names that have weekly options, you get about 600 names. That may seem like a lot, but it's just our starting point, right? Consider that the basket or the pool of all of the things that we could trade. Then when you start weeding it down even more, say by sector, industry, cost, right? Maybe we wouldn't want to trade things that are like $2 or $5, like InBev or things like that. Or maybe too expensive would be on the other side, right? That maybe Tesla options are too expensive for you, something like that. When you weed down the list, you can get that 600 names down to a much more reasonable size, 50 to 60 names. I made a video a while back that talked about using the most heavily traded names from the CBOE website on what was traded in the last month. So here we are in the first week of August. We would go back and look at July. And look at the names most heavily traded in July and use that for our benchmark. Here on TrendSpider, I've imported the weekly options list, those 600 names. TrendSpider won't let me make a watch list with 600 names, so I had to break the names into two groups. I didn't really use any rhyme or reason on where I split the names apart because it didn't really matter, right? I needed about 300 in one side and 300 in the other. And what we're looking at this morning is change percent in the pre-market. So how much has things moved on that list in the pre-market? I like to look at this list to see what sector or what industry in the pre-market is getting a lot of attention, because that attention very often follows through into the trading day, right? If pot stocks, for an example, are hot in the pre-market, they're very often hot through the trading session. So when I'm looking through this list, it's not just one individual name in particular, it's the collection of names. And that can be on the plus side or the minus side. So this morning, obviously, we've got a lot of names in the green. We would want to focus maybe on names that are not in the green, right? Names that have not yet begun to move, or that are starting out negative that might flip over on us. Tie that in with anything on the daily chart that gives me a trade setup. IX10, inside day breakout, TRB, breaking to 52-week highs, new 14-day high, new 14-day low, anything like that. Oh, come on. What is wrong with this thing this morning? Someone give it some coffee. All right, we're looking at the S&P 500. We don't want 500 names. So we're going to knock this down. First, look at the pre-market change percent, then use the filter by market cap and try to get it to around 100. It's kind of hard to hit right at 100, so kind of close is good enough. I want to adjust the color scheme so that it's more responsive. We just get rid of that gray area. This heat map shows the monsters of tech very easily because of the size of their box. The boxes are kind of a representation of the market cap. And then it breaks it down into groups for us, or quadrants or zones. So we can see technology, consumer durables, technology services. They're all looking pretty good. Finance is kind of a mixed bag. And retail seems to be a mixed bag. I would focus more of my attention on retail this morning than I would on a lot of the technology names. Or if you're going to go into tech, stay away, or maybe kind of sidestep a little bit those monsters of tech names. You can see there's a lot of technology out there that we could trade beyond the monsters of tech that still have a lot of liquidity, good market cap, reasonably decent options. a rotation through the sectors, right? If we're talking about capital rotation, if we're turning bullish again or getting into a risk-on marketplace, then health services, utilities, gas, energy, those things are less likely to be positive on the market, right? Our risk-on sectors are finance, technology, consumer discretionary. And that's what we're seeing this morning, right? Healthcare is flat, hasn't really caught a bid. Health technology, the ones that did catch a bid are negative, otherwise flat. Change this up to the S&P or to the NASDAQ 100. Now, the NASDAQ 100 does not have financials in it. But we can still see communications, utilities, transportation, technology, health technology, consumer services. We got a lot of markets that just aren't getting it. But what really stands out is the other technology names that we were talking about, especially those chip names this morning. The reason I brought up TrendSpider earlier and ended up coming over to here was how many of those names that have weekly options were green. There was a lot of names. Well, I want to put a number on it. Just saying there was a lot of names doesn't quite do it. How many names in the S&P 500, or excuse me, in the S&P 100 are up at least 0.5%? 25. Okay. So we say that another way. 25% of the S&P 100 is up this morning 0.5%. That's not bad. That's not overly bullish by any means, but it's not bad. That's a good number. It's a good start for the week. But let's take it a step farther. How many names in the NASDAQ 100 are up at least 1%? Not even 10 names. So not even 10%. So we're not seeing a lot of aggressive, gapped up, bullish market this morning. Now, we did sell off last night in the Globex Open, and then we rallied back up after that sell-off. So how many names are down in the NASDAQ this morning? At least 0.5%. Yeah, only 4. So nothing really negative out there. The pre-market gappers are mostly bullish, and we're looking at 25%. That's not too bad, but let's look at the S&P, because the S&P has financials in it. So how many names in the S&P 100 are up at least 0.5%? 26. So around 25% of the S&P, 25% of the NASDAQ. It's a good start. Remember that these gapped up names are very likely what's going to continue to move the most in the intraday trading session. So we want to focus on what's already getting attention. It's only 25 names, so it's not like, you know, you're really put out to have to go through and flip 25 names. If you're interested in seeing that on Thinkorswim, maybe you don't have TrendSpider or TradingView. Thinkorswim has a pre-built S&P watch list, so you can just go in. They're alphabetized. If you go to public, go to the S's, S&P 100. Click the little gear, customize, type in mark. We want mark change percent or mark percent change, whatever. That'll let you see what's moving in the pre-market on Thinkorswim. Now, it won't show up on the daily chart yet, but on the intraday, you can see the pre-market move, right? So for an example, Tesla gapped up this morning. It's off of the Globex high. That now gives us an internal pivot point. So when we open up at 9:30, that's going to be the first benchmark, the first line in the sand that we've got to get through if we're going to get bullish today. So if we're looking for a breakout, since Tesla's at the low of the range from yesterday's run, looking for a breakout would be us looking for a break above 940. We would be waiting half the morning for that. So another breakout that we could focus on is that Globex high, 489, excuse me, 894. Oh, I said 489. That's a weird number. If you are on the daily and you want to just kind of mark out some levels, an easy way is to train your mind, train your eye to get used to looking at this in the pre-market. Because that's where the market pretty much is. So we closed at 864, but now in the pre-market, we're at 881. So I don't have to go into the intraday to be able to mark out some levels. And that means we can move through this list really fast in the pre-market, especially if our benchmark is that we want names that have moved at least 0.5%. If I narrow this down to 0.5%, it's just these names right here. Well, that's not very many names at all. So Tesla's got a red to green. Ford's got a TRB set up. Remember, don't get too hung up when you draw your trend line for the TRB. It doesn't need to be exact. It's more of just a visual than anything else. We're bid in the pre-market at 1557. Right about there. So we've already gapped up completely outside of yesterday's price action. We want to be focused on what daily chart has the opportunity for us so that as we get closer to the open, we've already got our levels mapped out. We've got our expectations of what options we want to trade, what expiration, what series. We got our targets and our goals in mind. PayPal is another one that is up this morning, 1.4%. We closed at 95.32. We're already at 96.65-ish, 96.60, 70. That's not quite an inside day breakout yet, but we're really close. Again, a TRB. We'll just steal that line. 96.70. Close enough. That's where we're at right now in the pre-market. So if we get an inside day breakout, basically a red to green too. I mean, I know that's not a red day yesterday, but pretty darn close. Then we've got a red to green TRB. And the expectation is that by the end of the week, we could get back up towards 101, maybe 102. We've got a surge with momentum in a bullish trend and decreasing bearishness. Yeah, do that. So I like PayPal. PayPal looks pretty good. If we get that follow through this morning. Disney's up 1.25%. Again, want to look right there, 108.17. We closed at 106.63. We'll look at 108. That means we're already inside day breakout. Now that's a really wide range there. It's like 20 points, 20 cents, right? 107.96 to 108.25. So we'll just stop at the round number 108. We're already up that much in the pre-market. So what we'd be looking for with Disney is if it maintains this move, and there is earnings coming up. So, we're not going to keep this one. Day trade this only. We would be looking for a continuation of the move up to the 109.61 to the top of this big candle from last week. I would get rid of most of my position at that point, maybe try to set a runner and see if we can get a breakout. See if we can break out above 109.70. I don't believe we can, but I've been wrong before. GE. Closed at 74.36. We're already at 75.13, 75.12. TRB had a red to green Friday, but it was a sorry one. Didn't really follow through all that well. What we do have is an outsized candle. So the TRB failed on Friday. See if we can get that follow through today. The fact that we're above 75 means we're already inside day breakout. Right, so we're going to be opening this morning already up above that line. What? So the benchmark is going to be at the moment, just like that other chart we were looking at, the high of that big candle. 76.36. If we can get above that, great. But I would get most of my position out by that point. Maybe look for some UOA on GE and on Disney, right? To kind of go with that intraday play. Look for the flow to come in on those options, then pile in on it. Something like Whale Stream would be a really good way to do that, right? Bookings. I don't think I'm going to like the options on this. Let's just check those before we even do anything. Not even, no. Nope. It's trash. We don't want it. All right, Amazon closed at 140.80, and we're already up to 142. I don't think that gives us inside day breakout yet, but think of Friday almost like a red to green. It wasn't a red to green, but almost like one. And we're opening up this morning, or at least so far in the pre-market, we are up 142, right about there. So what we want to see with Amazon as we come into the open is, are we still below that line or not? Are we still below yesterday's high? If not, then when we come into the open, we want to see if it's going to hit that point and reject, or if we're going to get through that level, and then we'll focus on 143.5. If we can break the top of this range this week. What is this? Hold on a second. Not very many numbers ring through, so I had to check it. The kids are up early this morning, and that means the grandbabies are up early, and they just wanted to see what I was doing. Maybe we'll go have coffee today. That'd be cool. So anyways, Amazon lining us up for a nice play here. A break above 145 should put us in line to go to the 150. There's no earnings to deal with, nothing else on the docket. So we're just going to be looking for that continuation. Just keep in mind, after that earnings and that really big gap up and closing this other gap from early in May, that if we really haven't pulled back and tested things, that one small little red candle from 8.2 is all we've got. So you got to kind of have this expectation that at some point we're going to get a pullback. And if we lump Amazon in with a lot of those monster names, just because of its market weight, obviously it's not a tech, then, with that in mind, we could be expecting some weakness here. So on that gap up this morning, be very cautious of Thursday's high. And Thursday's high has been a candle that I pointed out on a number of charts this morning. If we're going to really kind of bounce around until Wednesday's CPI data, we're very likely going to reject on the high of that range. GE had a really nice setup, right? And I still like it. So I think out of the list, I think GE's gonna be pretty high up on my list. For Google, we're up 119.25, 119.30 ish. That gets us outside of yesterday's range already, but it gets us very close to this pivot point that I've been talking about, Thursday's level. For Google, that's going to be around 119.5. It's a solid rejection zone, especially if we're going to maintain this range that we've been in since like May. So I'd be very cautious with Google. It is one of the MOTs. Qualcomm, we've been getting those higher lows and equal highs until Thursday when we set that high breakout. And look at Friday. Qualcomm's chart on Friday looks a lot different than a lot of the other names that we were watching. It was an outside candle by wick, not by very much either. It wicked below Thursday and it wicked above Thursday's levels. Still closed inside day, but it's a big inside day, and the gap is not done. Now in the pre-market, we're up basically 152. That's the gap close, right? Because we're now way up here this morning at 152. Well, okay, but you know what? That's a pretty wide gap. We got 151.44 and 151.98. So let's jump into the pre-market and market line. So we're not above 152 yet. That bid and ask is just off a bit much. So we're at 151. We'll use the lower end, 151.44. We're right underneath that line. If we get a break above that line and we close that gap this morning, then 154 and then 156 is going to look really good in Qualcomm. Qualcomm is one of those names that I put in on the swing trade watch list. I put it in there on the 4th. That same wedge. We just haven't had that follow through yet. But the more time that we spend wedged there, the more likely the break is going to be a pretty significant size break. Adobe, we're broke out here. 436 is where we're at right now. So we're completely inside day breakout on this. We've broke the range. We've broke the rising wedge, and we're out. What we want to focus on is this next pivot point back here. That'd be 141.9. I'd call it 142. All right, so that's going to be the target on Adobe, and I like this one. Intel, strong trend line, that TRB. 35.58 means we're still inside this previous day's candle, but we're up near the very top. And again, that's not a red candle, but think of it very much like a red to green setup. So we got a lot of names this morning that we've went through, a lot of really good setups. And this is just the S&P 100 and looking at what's up in the pre-market, right? And we've got, a pretty good list. Now, when we get closer to the open, you may want to reevaluate that list, right? You want to go into the open with 3 of your top names and then maybe 7 more that are on a watch list, right? Because if you're using a heat map or a watch list rather than trying to look at 10 charts, it's not going to be that bad, right? You want to kind of get used to doing that so that you can swap quickly to the market that happens to be making the move. I think we've all done it before, right? We're sitting there watching a chart at the open. We're waiting for a move that never comes, and we miss a really great move somewhere else because we weren't looking anywhere else, right? So you should be able to see 3 charts pretty easy and then 7 on a list. That'll give you 10 names. If you're kind of new and you can't watch 10 names yet, work your way into it, right? Just like trying to work out and grow your muscles. Start with watching 2 charts and a list of 4. And then, grow that through experience a little bit at a time. Get better and better until you're comfortable watching a lot of names all at once. It is my day to stream. I'll be in the Bullish Bears at 9:15. Look forward to it. I'll see you guys there.